Good morning, everybody. Good morning and happy Monday, all you magnificent melonheads out there. Today's October 23rd, 2023. Top story this morning is those interest rates. They just keep rising. Once again, the 10-year treasury is flirting with that all-important psychological level of 5% this morning. We actually broke above it for the first time in a while since I think 2007 was the last time the 10-year treasury was this high. You may recall 2007 kind of led to some rather unfortunate events, financially speaking. It actually broke as high as 5.025 this morning. Now it's down off that high. It's currently around 4.97 on the 10-year right before we went live. But suffice it to say, we're looking at another run at that 5% level today. Interest rates just keep on rising. Other stories going on this morning. We've got Chevron just announced they're buying Hess for $53 billion. That is the second major oil merger in the last 2 weeks. You may recall last week, something we didn't talk about a lot, but Exxon Mobile bought Pioneer Resources in the U.S. here. That was a $58 billion merger. So we've got each of the two big oil majors have announced a major acquisition recently. Obviously, the oil companies are telling us that they think oil is heading higher and that they think it's going to stay there. So that's the important takeaway from those two stories. Other stories going on this morning. The Bank of Japan, there was some very strangely worded press coming out of Nikkei this morning or last night. A lot, again, unconfirmed, citing people familiar with the matter, some wishy-washy language like considering or maybe or possibly or in talks to. But they're kind of priming the pump to get people ready for a Bank of Japan that is not holding interest rates as low. Now, Bank of Japan surprised people back in July when they announced a tweak to their yield curve control policy. They had previously had the rate held at 50%, or I'm sorry, not 50%, wow, at 0.5% or 50 basis points. And they announced a tweak to their yield curve control policy back in July where they said, we're going to let it go as low as 0 or as high as 1.0. Which basically meant they're going to raise the cap as high as 1%. And then ever since then, the Japanese 10-year JGB or Japanese government bond has risen from about 0.45% to where it is right now at around 0.86. It's rising very fast. And it's going to hit that 1% cap pretty soon here, it seems. And once we get there, Japan is basically signaling to the rest of the world, hey, guys, we're going to let that run even higher than 1% soon. Now, Japan has been kind of a global outlier. They haven't had the high inflation that the rest of the world has seen, but inflation in Japan is finally rising, and I think it's rising a little faster than they were expecting it to, so that's causing them to step away from their yield curve control policy a little bit. Now with oil prices rising, I think that's got Japan particularly spooked because, Japan is 100% dependent on oil imports. Japan produces no oil at all. So a rise in oil prices can really affect inflation in Japan. It can really affect their economy. So it's causing them to back away from their yield curve control policy, maybe a little more aggressively than they had previously thought. And, the other thing going on this week, we've got a lot of big tech earnings are coming in. Tuesday, we've got Microsoft and Google reporting earnings this week. Wednesday, we've got Meta reporting. Thursday, we've got Amazon reporting. And then Friday, we've got Exxon Mobile and Chevron, the two big oil majors. They're not big tech, but they're significant, so I put them in there. We got a lot of earnings are going to report this week, guys. It's going to move markets one way or another. And the big question is AI ever going to actually translate into any revenue? Because we've heard all about AI for almost a year now. It's been almost a year. What was it? November of 2022 was when ChatGPT was released and took the world by storm, right? So about a year of this AI mania has been going on now. We should be starting to see some revenue from this. We should be starting to see, hey, guys, this is going to translate into actual dollars on our balance sheet sometime soon, or is it all just going to be hype? Well, we'll find out this week. Notably, keep an eye on Microsoft because Microsoft actually took out a position in ChatGPT. They're probably the only ones that are going to actually report any math whatsoever. Meta, Amazon, Google, they've all talked a big game when it came to AI, but it hasn't translated into any dollars or cents. And keep in mind, these names are up big this year almost 50, 60% on some of these Magnificent Seven names. Meta is up like 150% year to date or some ridiculous number like that. So it's time to put up or shut up when it comes to these big tech earnings. We'll see if we get some of that this weekend. And with that, I am going to shrink my big melon of a head and let's see what's going on. And while we're doing that, guys, why don't you please hit that like button and subscribe to my channel. If you're new here, have your coffee with the melon heads every morning. And the market is sitting here at a 26 on the fear greed index, just barely in fear territory, tickling that extreme fear threshold of 25 right now. And why is that? Well, it's got a lot to do with rising interest rates. The S&P 500 down 15 points ahead of the opening bell this morning. The Dow is down 141 points ahead of the open, about 0.43% lower on the Dow. And the NASDAQ is faring a little bit better than the Dow, down 45 points or 0.3% lower ahead of the opening bell. We've got the U.S. dollar is modestly weaker this morning, 106.1 on the Dixie. That's down about 7 basis points. And looking over at the commodities board, we've got gold is down by about $4. December gold futures trading at $1,990. That's down 0.2% this morning. December silver futures at $23.31. That's down 20 cents or 0.82% lower. We've got platinum and palladium are both a little bit higher this morning. And West Texas Intermediate December futures trading at $87.33. That's down 75 cents or about 0.9% lower. Now, it's the bond market that's making the waves this morning. It looks like bond yields are retreating from their highs. Remember, yields and prices inversely correlated. So when you see green here, that's bonds going down. The 30-year treasury is yielding 5.13%. That's up 4.5 basis points this morning. The 10-year currently at 4.962. That's up 4 basis points. It did reach a high earlier today of 5.025. Watch that all-important 5% threshold. We've been flirting with that level for a couple of days in a row now, but we have failed to break above and stay there. The 2-year treasury yielding 5.114. That's up 3 basis points, and the 1 month is unchanged at 5.416. Taking a look at this, this is the 10-year treasury going back a couple of days here, or actually a couple of months. Let's zoom in on the last 3 trading days in particular. This red horizontal line, that's your 5% number. And you can see we failed to break above it once, twice, broke above it today on the 3rd try, but then came right back down below. So are we going to close above that 5% threshold? That is the big question for the 10-year treasury. And moving on, let's talk about this one because this could potentially, this is a story that could send yields in the 10-year treasury sharply higher. What happens in Japan will affect the rest of the world because Japan is kind of the baseline because Japan has such easy monetary policy in place. It kind of sets the low bar for the rest of the world. And so a lot of money leaves Japan and goes into other bond markets chasing yield. So if Japan is willing to let their yields rise, that means that flow of capital could reverse back into Japan, which could cause problems in the US and Europe. BOJ may review yield curve control policy as rates rise. That's according to Nikkei. Now, pay attention to some of the language here, guys, because there's a lot of qualifiers here, a lot of maybe words. That's the one thing I want to stress here. Bank of Japan officials are pondering the question of whether to tweak settings on the yield curve control program as domestic long-term interest rates float higher in tandem with those in the U.S., the Nikkei newspaper reported on Sunday, without saying where it obtained the information. You got to love those anonymous sources. The topic will probably be discussed at the next 2-day board meeting that ends on October 31st, with some officials cautious about the idea that as they continue to monitor wage trends, Nikkei said. The speculation over potential changes to BOJ policy has simmered since the central bank surprised markets in July by loosening its grip on long-term rates under the yield curve control framework. The yield on Japan's 10-year government bond reached a fresh decade high at 0.845% on Friday before retracing after the BOJ said it would provide 5-year loans to banks. So, again, a lot of maybes, a lot of unnamed sources, a lot of pondering the question of or discussions about. Nothing certain here. But again, a lot of times these central banks, they don't like to surprise markets, so they will leak this stuff to the press first. The press will put it out there, and then when the central bank does it, it doesn't surprise anybody. So that's the only reason I'm bringing this to you guys, because what happens at the BOJ is very important to what happens in the U.S. bond market. And if you want to know what's going to happen in the U.S. stock market, pay attention to the U.S. bond market. And so this is very important. Now, what we're looking at here, this is a trend going back to December of last year on the Japanese 10-year JGB. And you can see this is them walking back their policy of yield curve control. The first time that they changed it was back here in December of last year. That's when they went from, what was it, 0.25% interest on their 10-year to as high as 0.5%. They shocked the world when they raised interest rates to 0.5%. And then they kind of left it there. It bounced around. It settled around 0.45%. That is until July of this year when this one came out. And that's when they announced that tweak to their yield curve control policy, where they said, instead of holding it under 0.5, we're going to let it trade in a range of 0 all the way up to 1%. And so the market interpreted that as we're going to let it rise as high as 1%. It took a step change higher, and then it's been grinding ever higher ever since, currently at 0.862. So what they're saying here now with this article is we may let it rise even higher than that 1% threshold where it's currently capped at. We're going to be at 1% probably within a couple of weeks here. So pay attention to that Halloween meeting at the Bank of Japan. That could send ripples through the U.S. bond market. And again, that the Japan carry trade, the fact that you can borrow money so cheaply in Japan, take that money over to the United States, and then buy assets in the United States that yield a higher interest rate than you're paying on that borrowed money in Japan. The basis of that trade, the baseline there is that cheap borrowing in Japan. If the borrowing in Japan gets more expensive, then people may liquidate those assets and go back and cover their short bet basically in Japan. They may pay back that cheap Japanese debt. So keep an eye on what happens in the Japanese bond market. And here's the other story making headlines this morning. Chevron to buy Hess for $53 billion in latest oil mega deal. Guys, the oil market is the one exception to this just god-awful economy all around us. The oil market is telling us, hey, prices are heading higher and they're going to stay there because Chevron and Exxon, both of the big oil majors, announcing $50+ billion mergers in the last 2 weeks. That is not an accident. That is the market saying we think prices are heading higher. The second major U.S. oil deal in just a few weeks, Chevron gains a foothold in fast-growing producer Guyana. Chevron agreed to buy Hess Corp for $53 billion, a deal aimed at boosting production growth as the U.S. oil industry bets on an enduring future for fossil fuels. What happened about the energy transition? And, oh, by next week, we're going to be off of oil and windmills and solar panels and unicorns and rainbows. I guess not. In an all-stock transaction, Chevron will pay $171 per share for Hess. That's a premium of about 10% to the 20-day average price, according to a statement from the companies on Monday. Hess shareholders will receive 1.025 shares of Chevron for each Hess share, giving the company a total enterprise value of $60 billion, including debt. The acquisition will give Chevron a significant foothold in Guyana, the South American country that is one of the world's newest oil producers. It will enable faster production growth and more generous returns to investors, according to the statement. So it looks like Guyana is what Chevron is after here. And again, they're paying a top dollar for it, a 10% premium to what Hess shares are trading at, $53 billion, 60 if you count the debt. The oil companies are continuing to, what's the word I'm looking for? Continuing to consolidate. And heads up for the rest of this week, guys. Again, we mentioned we have got big tech earnings coming in. We have trillions of dollars of market cap are reporting over the next few days. Strong ad sales, stable earnings and spending. Strong ad sales, stable enterprise spending are the wind beneath big tech earnings. Okay, Bette Midler. U.S. technology giants are likely to post their strongest quarterly revenue growth in at least a year as their legacy business is stabilized, but investors looking for signs of a boost from artificial intelligence may be disappointed. Wait, what? Investors looking for a boost from AI may be disappointed? What happened to the AI Mania and everything AI touches turns to gold? That narrative is starting to shift. Turns out maybe AI Mania was really just all hype afterwards. After all, maybe we'll find out this week, I guess. Microsoft, Google parent Alphabet, Facebook parent Meta, and Amazon are expected to have built on the recovery in their enterprise software and digital ads business as professional and consumer spending stayed resilient despite an uncertain global economy. So they're saying we're probably going to get pretty good numbers from Amazon, Facebook, Google, Microsoft. Here's the thing. These stocks are up so much this year. They need to post those amazing earnings because if they don't, those stock values are going to correct lower. And again, they better start delivering on this promise of AI, especially a company like Meta that's up over 100% this year. There better be something behind that. Otherwise, it's just going to snap right back. Now, just in a general commentary on earnings season so far has been pretty good for the market. Even though the market has not traded very well, it's, the S&P just broke below its 200-day moving average. But take the bank earnings, for example. Now, I was worried about the small bank earnings, and none of them were particularly good, but none of them were dreadful either. The big bank earnings were pretty good. We were expecting pretty good big bank earnings. But here's the point. Even though the small bank and the regional bank earnings weren't terrible, there was some good ones, there were some bad ones, but there weren't any, oh my God, this bank is going to be dead within a week. But look at the trading for KRE. This is the regional bank ETF. This thing was down almost 9% off its highs last week. Regional banks got crushed last week, even though their earnings were actually not terrible. There was some rough things in there, like Goldman Sachs took a big write-down on their commercial real estate. All the banks were reporting increased charge-offs for bad loans and setting aside provisions for loans going bad. But there was no Silicon Valley Bank. There was no First Republic Bank in this season's earnings. And yet, look at how far down, 9% in a week, the KRE ETF for regional banks. So this market is biased lower, is what I'm saying. In the absence of really good news, this market will trade lower. Keep that in mind as big tech companies report this week. And last story I want to talk about here, car owners fall behind on payments at the highest rate on record. Keep an eye on this one. Yikes. The risk of vehicle repossession is rising for many Americans facing a budget crunch. Americans are falling behind on their auto loans at the highest rate in nearly 3 decades, with interest rate hikes making newer loans more expensive. Millions of car owners are struggling to afford their payments. It's a clear indication of distress at a time when the economy is sending mixed signals, particularly about the health of consumer spending. The percent of, this is important here, these numbers, the percent of subprime auto borrowers, so this is borrowers with lousy credit, the percent of subprime auto borrowers at least 60 days past due on their loans rose to 6.11% in September. That is the highest in data going all the way back to 1994, according to Fitch. In April, that figure slipped from a previous high of 5.93%, but after burning through tax returns, contending with a shakier job market, and grappling with still elevated inflation, more car owners have become delinquent. And I would add to this student loan payments, because again, this is the data as of September. This month was the month that student loan payments came back, so this data is likely to get worse. Now, take a look at this chart here. Let me zoom in a little bit on this. This chart is showing delinquencies 60 days plus for subprime auto borrowers. All right. So again, understand what the chart is telling you. These are not people who have defaulted. All right. They're 2 months behind on their car payment. And this is only subprime borrowers. So this is only the people with the worst credit. But you can see on this chart that at 6.11%, this chart is higher than it has ever been, higher than 2019, which this trend was on the rise big time all through 2019, higher than the peak of the global financial crisis. It only peaked at 5% in the GFC. That was in January of 2009. We're way above that, and higher than this peak from 1997 or late 1996 of 6%. So subprime auto borrowers, 60 plus days delinquent, is at an all-time high. That's going to stress banks. That is going to stress used car prices. It's going to stress everybody. The consumer is just not as healthy as they're telling us. And again, all of this, guys, this is before student loan payments come back. And look at how fast this trend is rising off the bottom from the pandemic lows here. This thing is coming up fast. There is trouble ahead in the auto market. And I got a couple of thank yous I have to say this morning. Thank you so much to Heather Y for sending the super sticker. It was my little pair guy there. Thank you, Heather. I appreciate that very much. Thank you for supporting the channel. And thank you to JJ Watt, says debt clock added 14 trillion to unfunded liabilities last night. Well, gosh, that was pretty quick. 14 trillion in unfunded liabilities. I guess where we are going, that's a drop in the ocean. Buckle up, people. Now, guys, unfunded liabilities, that's different than U.S. debt. Unfunded liabilities is basically, consider it like, say a baby is born tomorrow. That baby is considered an unfunded liability for the Social Security system, which will have to pay that baby his entire retirement. So unfunded liabilities is not necessarily debt owed, but that is money that the government is going to have to come up with at some point in its life. So the unfunded liabilities number is huge, over $100 trillion. 14 trillion in one night. That's a pretty big adjustment to the upside, JJ. That's a good catch. I'm going to look into that one and see maybe what particular category that one came from. My guess is it's got something to do with Social Security and retirement age, because that is the big one. But other programs like Medicaid, Medicare, those are also in there. So we'll keep an eye on that. But thank you. Yeah, the U.S. fiscal situation, if you want to know why interest rates are rising in the bond market, why a 10-year treasury is pushing 5%, it's because the U.S. government is fiscally insolvent. It's just a matter of time. We all know it. It's just a question of, will we default by not paying it back, or will we default by inflating it away into nothing? Either way, it's a default, and people want higher interest rates in return for the risk that they're taking. Thank you, JJ, for the super chat and the support of the channel. And thank you, Mr. Steve Woitis. Steve is saying, who owns the debt on these auto loans? I can't tell you exactly who owns the debt on all those auto loans. I can tell you one bank in particular was particularly exposed to auto finance, and that was Ally Financial. Ally reported last week. The initial report, the stock rallied, so it wasn't terrible news, but then it sold off and it ended up closing the week lower. So when I hear auto debt going bad, Ally is one that I think of. Now, that one is behind us, and it was not a bombshell earnings report. So the auto loan market has not blown up. It didn't happen already. If it was going to blow up this time around, we would have seen it last week, and it didn't happen. But a lot of this stuff has been securitized. A lot of it has been sold. It's been by securitized means these loans have been put into bonds and sold to investors. Those investors are usually pension funds, 401ks, IRAs. Now, a lot of the people who did that, a lot of the people who packaged those subprime loans into bonds have gone out of business earlier this year, like U.S. Auto, American Auto Lenders. There was a couple of those patriotic sounding names that were basically just chop shops that took garbage subprime auto loans and packaged them into bonds and sold them. They shut down earlier this year. So the subprime auto market has already been sending us warnings for a while this year. It just looks like the delinquencies are finally starting to catch up. And that's an indicator for the rest of the auto market and the rest of the debt market, because you'll see it in subprime auto first. If you're going to miss payments on something, that's probably what you miss the payments on first. That, maybe the credit cards, you see delinquencies rising there. So who owns the debt on these auto loans, Steve? Short answer, chances are we do. It's been sold to our retirements. It's ultimately, that's where they dump all of this toxic debt. But as far as, stress in the banking system and where might it show first, my guess would have been a company like Ally, and we've already gotten through that one. So thank you, Steve. I appreciate the super chat, sir. And thank you to the Nashville Pasta Man for your super chat. He says, BMW here sold an i7 wagon, 175 cash. Buyer left his G-Wagon on the lot, told the dealer, tell the bank to pick it up. Note for $230,000 pending. Yikes. Bank asked the dealership if they wanted it for $80,000. A $230,000 note pending, and the bank asked the dealership if they wanted it for $80,000. So the bank is willing to take a loss of, what's that, $150,000 on a G-Wagon? Is this a true story, Nashville, or are you just coming up with numbers out of your out of your? So these are amazing numbers. $230,000 note pending on that, and yet the guy was able to buy. Okay, BMW sold an i7 wagon for 175 cash. Jesus. The losses are staggering. These car prices, I mean, you're talking to a guy like I drive beaters, Nashville. I mean, I have my 2017 Toyota Tacoma. I paid 28 grand cash for it a few years ago. I love that truck. It's the nicest thing I've ever driven. So these numbers, these are the numbers people pay for houses. It's amazing that this is what people are paying for cars right now. And look at the losses the banks are taking on that. $230,000 note pending. offering it for 80 grand. That's a lot of money that they're just walking away from. And whose money is that? That is your money, because that 150,000 that they lost, that money came from their depositors. So yikes, Nashville. Well, thank you very much, sir, for the super chat and for the support of the channel. And somebody else just jumped in there. It didn't pop up yet. Who is it? I missed somebody. Nope, it's just showing up twice. All right. Thank you very much, Nashville. I appreciate that, sir. Thank you for the support of the channel and for the eye-opening numbers. And thank you, everybody, for spending your morning with us here. I appreciate your time. Thank you to my Patreon supporters for everything you guys do for the channel. Link down below, should you feel so inclined. A lot of big tech earnings coming up this week, guys. It's going to be a bumpy road. We'll bring you the news as it comes in. And until next time, live small and dream big. Oh, and hi, Mom. Hi, Dad. I love you guys. Almost forgot.